As we continue on in our labor economics course and thinking about why different workers receive different wages, we have to think about the concept referred to as human capital or human capital investment. In this module, we'll talk about the valuation of capital, we'll talk about inputs to human capital, how we value human capital, the metrics or equations that we might use to value human capital. We'll talk about one form of human capital specifically, and that's higher education. We'll do that because all of us are involved in higher education, and we'll talk about that as in terms of the demand for higher education. And then we'll talk about some elements that we refer to as externalities. And you might recall that an externality is simply an unintended consequence of some economic transaction or some activity. We probably should stop and think about what it means to think of human beings as capital in the production process. If you think about this, human beings can be measured either simply as labor units, so one person, one unit, another person, another unit, or we can think about them as those units being differentiated by some productivity enhancement. And when they're differentiated by some productivity enhancement, we think about them then as capital in the production process, not simply labor units. An individual will be a labor unit, and will you have one labor unit being the same as another labor unit being the same as another labor unit, just in terms of their actual numbers. But when we think about the actual value, the production value of that labor unit, we have to think about their value as a piece of capital in the production process, not just as a labor unit, which also then means that different human beings have different productivity values. And so they are more productive or less, they can produce more or less, they are more or less valuable in the production process. And this might seem a little clinical, it might even seem a little bit cold, but the fact of the matter is that we are simply pieces of capital in the production process. And we've already talked about the fact that that we sell our labor for a wage. Well, the more productive we are, the higher the wage that we would hope to sell our labor for, the more valuable we are as a piece of capital. So just keep this in mind as we think about how we're going to talk about human capital and human capital investments as we're continuing our discussion of why different workers receive different wages. So let's talk about the valuation of capital for a few minutes. Capital generally can be broken down into several different types. There is physical capital, there is financial capital, there is technological or intellectual capital, and then there is human capital. Well, we can value these different forms of capital in different ways. And you'll find that there are three common valuation methods which accountants and or economists would use for valuing capital in production, human or otherwise. The first would be our book value, and this would be more of an accounting metric, the value that we hold the capital on the books of our company, our balance sheet. Our market value, and our income and production value. And then separately in this segment, we're going to talk a little bit about what's referred to as the Cambridge Capital Controversy. So let's think about book value for a moment. So book value, or the value that we note on the books of our company, probably our balance sheet, in terms of the value of our capital, typically has something to do with the cost of the capital, what we paid for it, minus some depreciation, which gives us then some remaining book value. And the depreciation is going to be indicative of some wear and tear on the machine or on the building, some depreciation in terms of the financial capital's ability to continue to provide rate of return, some depreciation of intellectual or technological capital because it's been outdated by some newer technology, some better innovation. But in terms of human capital, we have to think about how human capital depreciates. Well, if you think about it, human capital depreciates very efficiently and very readily. If you teach me something today and I go ahead and put that item into practice, I might use that very efficiently. I might use it with great productivity for some period of time. But over time, if I'm not using it or not using it consistently, I might forget, or I might just become more careless. And so the ability for me to produce for the company is less. That is depreciation. Or perhaps what I've been taught has been now replaced by some new teaching. I was taught a particular type of computer code, and that computer code is now outdated. So my human capital investment has depreciated. It's become less valuable, less efficient in the then current operating environment. So book value is the value that we think of from the accounting standpoint. It's the cost of the asset or piece of capital, the item in production, minus any depreciation. The market value is probably pretty easy to think about. When we buy something, somebody else sold something. And we know the price at which we agree to buy, the price at which the seller agrees to sell, is the market value. Oftentimes people are motivated to think that an item, an asset, perhaps even themselves, have greater value than they do. I have a good friend that is absolutely certain that his market value in the labor market is at least $100,000 a year. Unfortunately, he's never made $100,000 a year. He's never made a sum even close to $100,000 a year. So he supposes his market value is $100,000 a year, when in fact the market has evidence to him that it's well under that. Because when he is selling his labor and a company is buying his labor, they've never reached a price greater than, say, $60,000 a year. Well, that's in terms of the buying and selling of a labor unit with its enhanced human capital. If it's a piece of property, we might have an appraised value on that piece of property. Let's say the appraised value is $325,000, but I go to put that property for sale in the market, and I can only get, within a reasonable time period for it, I can only get an offer of $300,000. Well, that tells me that the appraised value is appraised high, and that the market value is less than that, or $300,000. Or maybe it's just the opposite. It's appraised at $325,000. But I am offered $350,000. Well, that market value, that value that someone is willing to pay, is the value that I would think of. And in fact, that's a value that we're often going to consider in different types of capital valuations. We can also think of some income or production value. And as we go further into this module, we'll focus more on this form of valuing human capital, which would suggest then that this capital, this equipment, technology, financial amount, or maybe this human capital, is able to provide some return on its investment based upon how it produces. So when we think about its production value, we have to think about what gains do we get from it, what additional production comes from that, what profits might be the result of that production, and if we know what the going interest rate is for productive capital, then we can take that gain and we can assign some current value based upon that metric. And again, we'll talk about this with greater detail in another segment in this module. But next, let's go to the Cambridge Capital Controversy. I was introduced to the Cambridge Capital Controversy very briefly one day when I was giving a presentation in the economics department at the University of Utah, and a renowned economist by the name of James Galbraith was there. Dr. Galbraith is a researcher and professor at the University of Texas at Austin. His father was John Kenneth Galbraith, who was an economic advisor to John F. Kennedy, perhaps one of the more better-known economic advisors of his day, and certainly one of the more powerful economic advisors of his time. And so Jamie Galbraith is his son, and I gave this investment of human capital discussion, and I didn't mention the Cambridge Capital Controversy. In fact, I was totally unaware of this. And Dr. Galbraith, at the end of my presentation, said, "Well, Mr. Haskell, what about the Cambridge Capital Controversy? How does this fit into this scenario?" And I tried to answer him, but immediately I realized I just couldn't, and so rather than feign a response, I just said, "Well, Dr. Galbraith, I'm not familiar with that." He went on to teach me about the Cambridge Capital Controversy, which emanates from the London School of Economics in Cambridge, England. And the Cambridge Capital Controversy would suggest that if we're valuing a unit of capital based on its income or production value, then we need to not only know the interest rate that we use in that valuation metric, but if interest rates change, or expected rates of return change, as they readily do, that means the exact same piece of capital, 1 year or one period of time to the next, will have a different value based upon that expected rate of return change and that piece of capital's production value. And if the value is going to change based upon that, then we don't have a consistent value. It's not a value changing because of productivity. It's not a value changing because of depreciation. It simply would be a value changing because of the expected rate of return or an interest rate within a market, in which case it's not consistent, it can't be counted on, and it becomes a valuation method that we really ought not use with any consistency. Well, the Cambridge capital controversy is very important to some of us, less important to others. We're not going to think about it other than I want you to know that it exists, and I want you to understand that it is associated with this income or production value. So when we think about human capital investment, we're thinking about not the labor unit, one from another, but we're thinking about enhancements to that labor unit that might come about because of some inputs that the human being or the worker experiences that enhances their productivity, gives them perhaps a higher market value, gives them a higher income or production value, would, if they could be purchased, give them a higher book value.